Good afternoon, everybody. So today I'm going to be going over mergers and acquisitions and the accounting considerations, concerns, and possible future regarding M&A. M&A is important as it serves one of the overarching objectives of corporations, which is maximizing profits. Profit maximization lets companies satisfy shareholders and management through sharing these profits. This is typically done through providing dividends to shareholders. With the growing American and global economy, organizations have to utilize strategies and techniques to retain and maximize their profits and provide dividends. While many corporations may settle for a slower long-term strategy, many corporations seek engaging in meaningful ways to boost growth quickly. Some ways to boost growth are through launching new products, entering new markets, leveraging company portfolios, increasing marketing reach, and research development. However, over the years, as technology has increased and made it easier to access information, mergers and acquisitions have become an increasingly popular option to maximize profits. With this increase in popularity, it's become important to understand what mergers and acquisitions mean as advanced transactions and how they will affect businesses. To truly understand the accounting issues that come out of an M&A transaction, it is important to understand what makes M&A an attractive option, considering the complexity that can arise. In the International Journal of Financial Accounting and Reporting, an article titled Mergers and Acquisitions, a Conceptual Review discusses 3 of the main reasons M&A may be considered an attractive option. The first reason is synergy. In this article, it is discussed that M&As provide the combining companies with synergy from both the corporate culture and combining core competencies. This, of course, means that from an accounting perspective, an accounting synergy occurs. The article quotes, "The return on equity and shareholders' wealth increases and it decreases any related expense, operating cost for the firm." End quote. This accounting synergy relies essentially on profits increasing and expenses decreasing. This typically occurs through the combining companies being able to keep profits stable or boosting them as the combination occurs and reducing costs through economy of scales. The second reason given is management authority. Ultimately, management will lean towards options that are attractive to them and align with the goals they personally hold. So when searching for company growth and profit maximization, M&A is attractive as it's an option that increases the company but also allows for management to increase its managerial impact. The third reason given is that M&A provides a way for organizational short and long-term objectives to be realized. A company that wishes to expand into a new country could take on the risk and commitment of expanding all by themselves. However, M&A would be a great way to reduce their risk by leveraging an already existing company that is in the country they want to expand to. Many overall objectives, like expansion, can use M&A to try and streamline the process of attaining their objectives and allow for a thorough discussion to occur surrounding what strategy is going to take place and what the risks are. In addition, despite M&A being a very complex transaction, it can often be seen as an easier way to cost out a strategy before any costs are actually incurred. Considering the overall attractiveness of M&A to management, it is important to note what the accountant's role should be. Maria L. Murphy, in her article Mastering Accounting for Business Combinations, which was written for the Journal of Accountancy, discusses that there is an overarching issue when it comes to M&A, and that is that combining companies often focus on just the strategic portions of the transaction, or rather, what draws them to the transaction. With this focus, accountants are often left out of the discussion on high-level concerns and the ultimate resulting impact on financial reporting and cash flows. Considering that the FASB standards are a very specific and complex accounting area, and the complex layers management adds to the transaction, these transactions will never be simple and should include accountants. It is actually imperative that they do. Only by involving accountants can issues be addressed, such as understanding if an M&A will actually be profitable, how M&A may affect their shares, how goodwill impairment plays a role, and if M&A could be a vehicle for earnings management. It is also only through having accountants involved that the current GAAP treatment of M&A can be evaluated. This is important as M&A has experienced many changes over the years, and with deal volumes increasing globally over the last several years, it is imperative to continue to evaluate how beneficial the current GAAP treatment for M&A is and how much it aligns with the reality of M&A transactions. In June of 1953, the American Institute of Accountants, now known as the American Institute of Certified Public Accountants, released Accounting Research Bulletin 43, also known as ARB 43. This ARB mentioned in Chapter 7, Capital Accounts, Section C, Business Combinations, that business combinations should be accounted for and that they should include some line items going to capital accounts. This is the briefest mention of business combinations and really didn't explain what they were or other detailed accounting issues that were involved. It wasn't until 1957, or 4 years later, that ARB 48 was published. This ARB was fully dedicated to the topic of business combinations. Even while fully dedicated, it made short work of the topic by essentially saying that business combinations should, as a general philosophy, differentiate between business combinations that are purchases and those that are pooling interests. ARB 48 made no legitimate requirements for organizations participating in M&A. However, they stated that there was an underlying difference between purchases made with cash and those that used other assets or equity to settle the purchase, and that this was an important differentiation to make. It was in August of 1970 that ARB 48 was superseded by APB 16. This APB was also fully dedicated to the topic of business combinations and searched to define, clarify, and establish further accounting methods for business combinations. They did this through attempting to address three main problems. The first was the definition for business combinations. Business combinations were defined as, quote, a corporation and one or more incorporated or unincorporated businesses are brought together into one accounting entity. The single entity carries on the activities of the previously separate independent enterprises. From this definition, they continued to define two accounting methods. While it was previously mentioned that there was a differentiation between a purchase and pooling of interest, this APB defined the accounting methods purchase and pooling. They established that both accounting methods were acceptable but should be used in two separate scenarios. The purchase method should only be used when a cash purchase was at hand. However, the pooling method should be used when other assets, and especially equity, were being used to create the merger or acquisition. While APB 16 outlined these two accounting methods and further solidified when they should be used, it also went on to clarify that if APB 16 would influence you to change the actual accounting method you're currently using, it should not. This established that APB 16 was not a retroactive functioning APB, but rather just for companies that were currently going through M&A or would be. For the purchase method, they established that the purchase should be allocated to the cost of assets and liabilities as booked, and that any difference in the cash payment and the actual worth of the assets and liabilities should be put to a difference known as goodwill. In this, they established the overall matter of goodwill, which helped differentiate between a purchase and a pooling, and allowed for any overpayment to be accounted for. APB 16 remained in effect for about 30 years. However, in June of 2001, FASB released a Statement of Financial Accounting Standards, which was number 141. This superseded APB 16, Business Combinations, in all material matters, and directly spoke to financial statement users' concerns that had grown over the last 30 years. These concerns revolved around the boom in mergers and acquisitions and the dot-com bubble. Mainly, financial statement users wanted to see clear comparability and wanted to make sure that financial truth was revealed when looking at the financial statements. In order to address these concerns, FAS 141 made three changes. The first is that they reduced the accounting methods available to one method. Instead of having the purchase and pooling method, they changed it to just the purchase. They also changed how intangibles were recognized. Previously, intangibles were just in goodwill or could be listed in the footnotes. However, with FAS 141, intangibles became recognizable on the balance sheet if there was a contractual legal criterion or separability criterion that was met. The third change they made is that they created further disclosure in the footnotes as to strategic reasoning for M&A. This increased comparability and allowed for financial users to see what the reasoning for the M&A was and to see what truth there might lie underneath the actual accounting transactions. In 2007, a revision was made to FAS 141. With quick changes in technology, it became apparent that an update would be needed. There was an increased focus on clarity, comparability, and why M&A occurred, and so they increased recognition of non-controlling interest, allowed for further recognition of intangible assets, and increased recognition of measurement for goodwill and bargain purchases. Looking over the history, we saw that there were clear concerns throughout history with M&A. Just as we've seen in the past, there are current concerns when it comes to big topics in M&A. I'm going to take a deeper look into a few of these. Some of these overall concerns in M&A are they even profitable? What happens to the shares during an M&A? How does goodwill impairment react and interact with M&A transactions? And what is the room for earnings management? When it comes to M&A profitability, we see that sizable positive market returns are seen for the smaller company being merged or acquired. But on the other hand, we often see that the larger firm either sees a reduction in profits or stability in profits. This means that there's a general net to a combined positive adjusted return for the business combination. However, it's been seen that recognizing losses in a timely manner is needed in order to recognize profits. So it's imperative for the larger company to have timely accounting recognition and make sure that they're looking at all of the transaction effects as they want to retain profitability. When it comes to the relationship between shares and M&A, we see that overpriced shares often encourages M&A to happen. However, overpriced shares lead to notable losses most of the time. So, using a sample of 1990 to 2006 business combinations, it was seen that not only do shares and M&A interact in this way, however, the losses are often tiable to accounting practices not being on top of things. So it's imperative for shares that the accounting is looked at and prioritized during the forming of the business combination. When it comes to goodwill impairment, this is a key issue because most financial statement users do not like to see big drops or changes in accounting numbers. So goodwill impairment can drastically change what financials look like, especially the goodwill. However, recognizing goodwill impairment is key to ensuring M&A profitability and making up for any share overpricing that may have occurred during the business combination. The final key concern I want to discuss regarding M&A transactions is that of earnings management. Earnings management is seen as a huge possibility when it comes to these transactions as they have such complexity. Considering this, there's hope for simplification moving forward and more recognition of accounting issues and defining what should happen in certain areas. Financial statement users also want to see disclosure of management reasoning to further extents. This has resulted in changes such as CAM, which is coming forward, which means critical audit matters, and trying to ensure that more clarification and less ambiguity is involved in the financial statements. Looking to the future, many hope that there is recognition of the complexity of these transactions. The social responsibility can be addressed in future accounting transactions, that there can be continuing growth and global convergence so that M&A can be more understandable across the globe. If you have any questions, concerns, or thoughts, please let me know. I'd love to have further discussion on this. Thank you.